So let's say that Anakin and Padme find out that they have twins on the way, so they need to upgrade from their condo on Coruscant to a big, beautiful house on Naboo. When they're shopping for this house, they need a loan. So who do they go to? They go to a bank, and that bank lends them money so they can buy the house. Hooray, happy family. But this is only the start of the process for mortgage banking. This bank most likely didn't lend their own money. They got a line of credit. That line of credit is extended to them, could be a couple $1,000,000, could be a couple $100,000,000, depending on the size of this bank. They borrow money from that line of credit so they can then lend it to Anakin and Padme to buy their house. Then they pay back their line of credit. Usually they have about 30 to 45 days to do this. How do they pay back that line of credit? Well, this bank is not just making one loan, they're making multiple loans. And they take those multiple loans and put them into a pool. You got Anakin and Padme's loan, along with quite a few other loans. They take those pools of loans and they sell them to bigger banks. Big, large banking institutions buy these pools of loans. In the industry, we commonly refer to these banks as investors or aggregators. Now, these big banks also lend to people like Anakin and Padme. But a lot of their business comes from buying pools of loans from smaller mortgage banks. Once they buy this pool of loans, this bank gets their money back, they pay back their credit line, all is well in the world of this mortgage bank. Now, this larger bank has a big pool of loans, along with all the loans that they made to people like Anakin and Padme, and loans that they bought from other mortgage banks. They're buying lots of these pools and aggregating them into larger pools of loans called mortgage-backed securities. These mortgage-backed securities, once big enough, can be issued to the investor market, secondary market on Wall Street, where all these lovely investors looking to invest their money into mortgage loans can purchase mortgage-backed securities. Once they purchase these mortgage-backed securities, this bank has their money back. This bank may have lent their own money, but they may not have. Sometimes they have lines of credit very similar to the smaller banks, only their lines of credit are a bit different. They're larger, they don't have 30 to 45 days to pay them back. They have 4, 6, 9, sometimes 12 months to pay them back. Depends on how it's negotiated, but these banks have a lot longer to pay back their lines of credit because it takes longer to get a mortgage-backed security issued. These investors purchase the mortgage-backed securities. These monies go back to the big banks. The big banks pay back their lines of credit or pay back their other investments, whatever they need to do. Everything is right in the world for everybody along the line. And Anakin and Padme are happily making the payment on their mortgage. So there you go. Mortgage banking 101. That's kind of how it works.